In 1994, the world leaders met in Bretton Woods and agreed on one simple rule: to make the US dollar the backbone of global trade. 80 years later, stablecoins are doing the same, but in code. Stablecoins were created to offer stability in the wild world of crypto. Dollar backed by some of the top issuers like Circle and Tether. Welcome to Block Recap. In this episode, we will explore stablecoins, Circle's IPO, and role of stablecoins in shaping global finance. On June 5th, 2025, Circle went public at $31 per share, giving it a $6.8 billion valuation. That is not just an IPO. That is Washington's official endorsement of programmable dollars. It is Wall Street saying yes to programmable money. Circle earned $156 million profit on $1.68 billion revenue in 2024. But the real story is what happens next. For the first time, a company issues digital dollars trades on New York Stock Exchange. This creates a feedback loop, and let's see why. Circle's stock price becomes tied to how much digital dollars the world wants. More USDC demand equals higher Circle stock price, which equals more institutional investment in stablecoin infrastructure. Circle's IPO kicks off a three-way battle for digital dollar dominance. Tether still leads with 66% market share, earning $13 billion in 2024, which is more than Goldman Sachs. But Tether operates offshore with limited transparency. Circle's IPO exposes this weakness. Stablecoins like DAI, Ripple USD, and PayPal USD have minute market share. Then we have big tech, Apple, JP Morgan, and others who are watching Circle's IPO closely. If Wall Street rewards stablecoin business models, expect major announcements soon. So why do you think Washington loves the idea of stablecoins? The Genius Act, bipartisan legislation. It wants stablecoins backed 100% by US Treasuries. Circle's IPO makes this strategy real. Here is the genius part. Instead of begging foreign countries to buy US debt, Washington lets anyone hold digital dollars with their smartphones. Every USDC created means more treasury purchases. It's an automatic demand for US government bonds. Circle becomes massive treasury buyer, creating stable funding for Uncle Sam while exporting dollar dominance globally. It is Bretton Woods 2.0, but through internet instead of treaties. Here is what is changing in global economics. First, with money printing. When the Fed wants more dollars in circulation, it expands its balance sheet. With stablecoins, treasury issuance becomes the primary mechanism. More USDC demand means more treasury purchases by Circle. Private demand now fuels public debt without direct Fed intervention. It is programmatic monetization, which is slower, distributed, but politically bulletproof. Second, with a shift in user behavior. The Fed sets rates, but stablecoins issuers execute them. Circle holds bonds, earns the yield, sets the margins. Once the user behavior changes, we will witness more wallet transfers, which will become a proxy for capital flows. When 100 million users shift from USDC to PayPal USD, that is not just a tech preference, it is reallocating treasury demand at scale. Third, capital controls become obsolete. Emerging markets want dollars, not local currencies. Now they do not need banks. They need internet and a smartphone. Capital banks lose control of money supply. The dollar strengthens not through military bases, but through wallets and wallet transfers. Why hold dollars in 0.5% savings account when PayPal USD pays 3.7%? The traditional banks will be challenged for deposits. Regional banks get squeezed first, then will not be able to compete with treasury-backed yields. There would be quote-unquote banking disintermediation. Traditionally, Fed rate hikes, which lowers inflation by making borrowing expensive. But stablecoins flip this. Higher interest rates make stablecoins more attractive. People part money in yield-bearing stablecoin instead of spending. It is deflationary through hoarding, not borrowing constraints. Countries with weak currencies face a dilemma: ban stablecoins and create black markets, or allow them and watch domestic deposits flee to dollar stablecoins. Either way, local currency demands craters. The dollar wins by default. Freelancers in Nigeria can now receive USDC payments instantly, bypassing expensive wire transfers and currency conversions. This creates global wage pressure. Why hire locally when you can pay remote talent in stablecoins, adjusted for their purchasing power parity rates? Now, let's discuss some potential risks that can arise with stablecoins. If everyone holds stablecoins instead of bank deposits, traditional monetary policy breaks. The Fed cannot inject liquidity into banks if money lives in wallets. Circle becomes more systematically important than regional banks. And how do you tax yield on stablecoins? Is moving from USD coin to Tether's USD a taxable event? Stablecoins create regulatory arbitrage between jurisdictions. Tax compliance becomes voluntary. Also, stablecoin issuers like Circle can freeze assets instantly. Imagine if USDC freezes and becomes a tool for economic pressure. It could be even more precise and harder to avoid than traditional systems like SWIFT. And what about countries like Russia and China who want to reduce dollar dependence? Stablecoins make this impossible. Citizens can hold dollars without touching US banks. Governments can ban stablecoins, but that just creates a black market. So stablecoins do not threaten dollar dominance. Instead, they might just become a catalyst. If Circle's stock crashes, does USDC lose its peg? If Tether faces regulatory pressure, does crypto market liquidity dry up? Stablecoin risks may directly impact monetary stability. So, to wrap up, Circle's $6.8 billion IPO is not just a milestone, it's a declaration. We are witnessing the birth of programmable money infrastructure, where private companies issue the world's reserve currency, smartphone wallets compete with central banks, US debt gets automatic global buyers, and traditional banking gets unbundled piece by piece. The dollar is not just replaced, it is getting an update. Circle just became the first company to make that upgrade public. Washington backs stablecoins because they preserve dollar dominance without diplomatic pressure. And the Genius Act formalizes this. That is, make everyone want digital dollars that automatically sells the US debt. The question is not whether stablecoins will reshape finance. It is whether Circle will dominate this new world or just be the first to go public in it. Nonetheless, Circle for now is the golden child. But as this market matures, stable dollars might become another way of approaching bond market. Maybe we might just call them the shadow banks of tomorrow. That's it for today's episode. If you liked this episode, follow us and share it with a friend. And as always, this podcast does not offer investment advice. So tune back in when we have another crypto story at hand. Until then, see you next time.